Alrighty, it's 10:30 now, and I want to welcome everyone for joining us today on this important webinar about mastering your retirement. Welcome everyone. That if I missed your name as you joined in, thank you again for being here. So before we get started here, I'm going to turn on my video in a second. Okay, so everyone should be able to see me now. Again, good morning. My name is Matt Lippert, and I'm going to be your host today for the Master Your Retirement webinar. Before we get started, just a couple quick housekeeping items. I know that a lot of you have already figured it out already, but we are going to be using the chat feature to collect your questions today, and I'm going to try and answer as many of them as I can. If I can't get to your question today, I will follow up afterwards, so don't worry about that. So if you're on a tablet, an iPhone, or an iPad, or any other smart device, just do me a favor, tap the screen right now, and you should be able to see three icons pop up: Q&A, chat, and raise your hand. So like I was saying, chat, if you click that option, that's going to be where we're going to be taking your questions. If you're calling in from a computer or a laptop, you can just sort of hover your mouse near the bottom or the top of the screen and be able to see that chat bar option. Okay. All right, so before we jump into everything, I just want to say that I'm really excited that you're all on the call here today. I'm excited to be here. I absolutely love doing these seminars because I know there's a lot of really good information that we get to share. I know that there's been a lot of anxiety and stress with the markets over the last year with the COVID pandemic, and what I'll say is sort of the roller coaster of what we saw with the stock markets over the last year, and now sort of this ebb and flow with the vaccine rollout. So to do this seminar today through Zoom is a really awesome medium that I'm sure a lot of you have gotten familiar with over the last year. And I know just how important it is, this specific topic, because it's extremely important retirement paycheck for our clients. And I know it's an important enough topic for you to join today. So with the wrench that COVID-19 sort of threw into the mix over the last year, a lot of people are looking for clarity around those questions on, am I still on track for retirement? What can I be doing better to be better prepared? That kind of thing. How can I reduce the taxes that I'm paying into and prior to retirement? So I've been talking about this topic a lot with people who have been referred to our practice over the last year, people who are, gearing up for retirement, who are already retired, and there's sort of three main concerns that come up pretty often, and that we're going to be kind of addressing today in the webinar. So the first one I always find is people are, sort of underliving in the fear of overspending. They don't necessarily have a plan on how they're going to withdraw from their nest egg in both the good years and the bad years. And the advisor that they've been accumulating their savings with maybe isn't a specialist in retirement income planning, taking advantage of all the tools that are available to them, like income splitting that Jennifer, you mentioned earlier in the chat. So I know just how relevant all of this is. So last little note here to touch on before I go to our first slide, since I get this question a lot. People ask, Matt, can I ask you some questions outside of the webinar? The quick answer is yes. I don't charge for any of that. I'm going to have my assistant who's helping me today, Lisa, just drop my calendar link into the chat right now. You can click on that link and schedule some time with me whenever's convenient for you. All right, let's get started. Okay, so just a couple really short introductions here. I'm on the right-hand side of your screen. My name, Matt Lippert. I'm a certified financial planner and a registered retirement consultant. So this topic around, mastering your retirement is one that I'm very familiar with. Neil Menk, that you'll see on the left side, is one of the founding partners of our practice, Davies and Menk. He's been the principal with the practice for about 28 years now. And together, the two of us, along with our excellent support staff, provide continuity for each of the families that we serve. Okay, so here's a look at the agenda of what we're going to be covering today. Very important first statement, I think, here. When markets are turbulent, which they certainly have been over this past year, keeping a long-term focus on your financial goals is more important than ever. Not letting your emotions take you off course. So we're going to be discussing how a full picture financial plan can help you navigate those ups and downs. So firstly, we're going to be covering current market conditions, which are obviously very relevant. staying the course, which I'm going to say is sort of the theme of this webinar and the most important thing when we're talking about retirement planning. Number 3, we're going to be talking about strategies to navigate the turbulent times. And lastly, we'll touch on our approach, how our practice looks at retirement and planning, and how we work with our clients to ensure there's no doubt when it comes to their retirement success. So market volatility, it's funny. The only constant is change, and we've absolutely seen that over the last year. When it comes to the economy doing one thing and maybe the markets are doing something completely different, I know a lot of people have sort of been scratching their head about how, divorced the economy and the markets can look like over the last year. And I'm sure everyone on this call has been involved in the market in some degree, whether you're investing through your bank, an advisor, or just doing it on your own. So in talking about market volatility, last year was a really great example of this, right? We sort of saw 3 periods in 2020. I'll call them, January 1 to March 23rd was a period of rapid decline, as the COVID pandemic sort of spread around the world globally, and we started to see businesses shut down and an economic shutdown, and the effect of the fear and the sell-off was pretty dramatic from January to March. From about March 24th to June 30th, we had a period of rapid incline where we saw, central banks and governments sort of interdict what was happening in the markets by, almost printing money, it seemed like, with a lot of the stimulus packages that they implemented. But we really saw the markets kick back after that. The last 6 months of 2020, the third period that I was just mentioning, from about July 1st to December 31st, was a period of steady incline, where we actually saw a couple indexes set all new record highs, which is something that I don't think a lot of people would have anticipated at the beginning of the year. But it's interesting how markets and volatility work like that, right? So, and we've seen a pretty good start in the markets to 2021 so far. So now there's a few new factors that I would say have come into concern, and what economists and analysts think could have effects on market volatility. With a lot of that, that heavy-handed monetary and fiscal policy last year to sort of get us out of that rut at the beginning of the year, there was a really big increase in money supply into the economy. So now there's sort of a concern with, well, as the markets start to open up, or the economy, starts to open up with the vaccine rollouts, what is this effect on money supply going to have on things like inflation? Are we going to see a couple of years of higher inflation? And now with interest rates at almost zero now, right? If you go into your bank and you go in and take a look at GIC rates, GICs are paying less than 1%. Your bank savings account is paying next to zero. So if inflation is going up and interest rates on really secure type investments like that go down, you're almost getting into this territory where you're getting negative real returns after you subtract off inflation. So, market volatility is going to continue making a play on that. So markets are going to go up and down all day long, and we've had quite a ride over the last year with one of the fastest market sell-offs in history. When I was saying in period 1 there, we saw markets drop 30 to 35% in just about a month, which is something that hasn't been seen that quickly anytime in the history of the equity markets. So uncertainty is definitely there. The one constant is change when you're dealing with market volatility. So I really like this slide. I think it puts things into perspective. It's really important to see where we were before and when we're trying to determine where we're going. So it's now been over 10 years since 2008, but I'm sure many of you still remember the housing crash, the financial global crisis that happened in 2008. The death of capitalism essentially is what all the headlines were saying. The bull is dead. That was the headlines in the articles at that time. And well, great, we were down 30% in 2000 and in early 2009. By March 9th, 2009, markets basically just took off like a rocket and didn't look back for about almost 11 years. And yeah, there were some ups and downs along the way, but that run for 11 years was a positive return of about 350% since the bottom. So, I don't think the bull was dead at all at that time. As a matter of fact, he might have just been sleeping in a little bit. But I think this is a really great slide for just kind of putting things in perspective. So the sum of all fears, and I'm pretty sure there's a movie called that. But if you look at for the biggest equity indexes over the last 11 years, so what we're looking at here is these 4 indexes from December 31st, 2008 to December 31st, 2019. So 11 years. If you look at the S&P 500, which is the largest U.S. stock index, from that 11-year time period, it returned about 15.3% annually. The MSCI World, which stands for Morgan Stanley Capital International World Index, returned about 12.5%. Europe was about 8.9%, and Canada was about 9.2% over those 11 years. So let's just say hypothetically you owned 25% of each of these indexes in your portfolio. Over those 11 years, you would have averaged 11.3%. The problem is most people didn't. And why was that? And it really comes down to the cost of lost opportunity, right? Opportunity cost. What did you miss out on by not participating? So what we're looking at here on this screen, the bottom part of the chart, the gray or the black lines, however it's coming across on your screen, shows the outflows of equities over that 11-year time period, or people essentially selling out of the stock market. The blue line above this is showing the inflow into income mutual funds. And income mutual funds are things like bonds, treasury bills, mortgages, really conservative type investments. So you're seeing over that course of 11 years, there's a really big differential if you look at these two totals. So there's a ton of outflows of equities or stocks and a ton of inflows into safer places like income mutual funds. So if you recall that last slide, I was saying, the average was 11% in the equity markets over that same time frame. So my point is, these people here, the average investor had a huge missed opportunity because they chose to step out of the equity market for whatever reason. Something that I know happened a lot in March and April of 2020, right? So, not the right move. This is the type of cost that can absolutely affect your retirement success. So I've got a question here from Jason. Jason, I'm just pulling up the chat here again. Hey, Matt, how are you meeting with people that have questions after the webinar? So thanks for the question, Jason. Our team has been working remotely from homes for about a year now, which is kind of crazy to say. So we aren't meeting with anyone in our physical offices right now. But I'm happy to meet with you over a video conference just like this, or over a phone call, whichever you prefer. But again, we're not meeting face-to-face at this time. So if you'd like to book some time, the link to my calendar is just in the chat for you. So another great slide here, putting things in perspective and just taking a step back again with, markets are always going to recover despite volatility. And it's very easy to get the blinders on and focus on all the things that are happening right now. What this graph is saying is, if someone put in, $10,000 into the Canadian stock market in 1956, and they never put another penny in that portfolio for the next 63 years until the end of 2019, that $10,000 would have grown to almost 2.2 million. An average of about 8.93%. That's pretty staggering, right? When you look at all these red dots on the screen here, most people are looking at these as, concern. They're looking at them as fear, or the sky is falling, that kind of thing. But my team and myself look at these sort of as the opposite. They're opportunities to review the plan. They're opportunities to buy things when things are down or on sale. That's how we see these red dots, because there's some pretty drastic drops in here when we look over the history over the last 63 years in the Canadian stock market. If I look at April 1970, markets were down for 3 months, negative 18%. March 1974, down for 7 months, negative 32%. Going into December 1981, markets were down for 7-month duration again, negative 27%. If we flip down to year 2000, which I'm sure some people on this call remember, that tech crash, the panic of, what's going to happen with our computers and our clocks? Are they going to be able to turn that digit over to the year 2000? So we saw 13 months of negative returns, negative 38%. And then if you look at 2008, which is the most recent recession in memory that everyone always talks about, negative 43% over that 9-month period brought on by a housing and a credit crisis. But guess what? Every single one of these drops, the markets always bounce back. And the same thing for last year. If that was on this graph here, we'd see, January to March, a negative 35% drop in the markets, but they came back very quickly. So we really need to always make sure that we're, taking a step back and sort of looking at the bigger picture. And I can't remember where I picked up this saying from, but I've been using it a lot over the last year. Whenever we're looking at the present, we need to look at it from some point in the future. So let me say that again. We need to look at the present from some point in the future. So think about that for a moment. So if you were sitting here in 2008 as an example, and you were so focused on that time period, what would happen if you were to take a look at that day, 3 or 4 years ahead in the future? So you look backwards, you looked at today from some point in the future. Would you buy or would you sell at that point? So, I always thought that was a really good way of looking at things. So what can you do now to protect your nest egg, right? We've talked a bit about volatility so far, and what are some things that you can be doing right now to make sure that you stay on track? So first of all, the obvious one is you got to have a plan and you have to stick to it. So understand what your plan is or what your game plan is when the markets go down and when they go up. So all of our clients, they have written financial plans that they have access to 24/7 on their online portal. It's not something that you want to throw in the drawer and just forget about. It needs to be customized for your current situation and also adjusted regularly. So when we meet with them, we're educating them, we're hitting on the important parts that need more clarity, and they understand that markets are going to do what they're going to do, right? But it's not going to derail you from your plan. So my question for everyone on the call here is, do you have a plan right now? Are you updating it with your advisor and meeting with them often? Are you worried when we see stock markets go crazy like they did last year? So those will be questions that you have to answer for yourself. The second thing is you have to have proper diversification. We've all heard that saying, don't put all your eggs in one basket. Proper diversification is really twofold. The first component is global diversification. The problem is in Canada, there's home country bias is what they call it, right? We have the majority of Canadian investors have really high weighting in Canadian investments. And the problem with that is the Canadian stock market only makes up about 3% of the entire world's market cap. So, that sort of tells me that there's a lot more opportunity out there than just in Canada. The second thing that you need to make sure with proper diversification is a right balance between equities or stocks and fixed income or bonds based on what I'll call your sleep at night factor, your risk tolerance. And I know this is something that's sort of been brought into question in the last year about, what mix should I have between stocks and bonds, especially right now with interest rates so low, can I afford to have 40 or 50% of my money in bonds earning less than 1%? So this is something that you should be reviewing right now, specifically with the interest rate environment. Strategy number 3, invest for the long term. I'm sure everyone on this call has heard this before, and we just covered all that. I don't think I need to show you any more proof about it. But the most important thing is to stay invested. So time in the market, not timing the market, is what's going to build real wealth over time. So strategy number 4, determining your retirement income withdrawal strategy. So all of these are really important, but I would say this one is particularly important to have an answer for. So for everyone on the call today, when you're retired, or if you are currently retired, do you know that, when you should be taking money out of your RSP? Are you doing that first before your tax-free savings account or your non-registered account? There's not going to be a right answer for everyone, but it's hugely important to have a handle on your retirement income withdrawal strategy, especially for people who are in what we call the critical 10 years. And the critical 10 is, the 5 years before retirement and the first 5 years of retirement. Decisions around your portfolio structure and where you're withdrawing your money from first for lifestyle can have a really big impact on how long that money is going to last for. So these are, specific years that you need to be really honed in on how you're going to determine your withdrawal strategy. And then lastly, take professional advice. I know this is a bit of a plug, but I can't say this enough. Someone to simplify the situation, provide clarity for you, and more importantly, guide you away from those decisions that could end in failure. So take professional advice. So what does peace of mind look like in retirement? Before I go to the next slide, I've got a question up here from Cindy. Cindy asks, how much do you charge for a meeting to ask some questions about my retirement? So thank you for the question, Cindy. I mentioned it earlier, might have jumped on later, but I don't charge for meetings. Even if it's one question or two quick questions and you just need 15 minutes of my time, use me as a resource. I'm here to help. So again, I think Lisa, I can see it here, dropped in my my calendar link in the chat, so you can click on that and just book some time with me. I'm happy to help, and we don't charge for that. So, moving on to this next sort of topic here, Canadians are enjoying longer retirements, and this is a stat that I'm sure you've probably heard when we're talking about Canadians who are 60 years old today. And I'm sure some of you on the call today are in this age range. So if we're looking at 60-year-old Canadians today, about 50% of males are going to live beyond age 83. And no surprise, our female counterparts are probably going to outlive us, with 50% of them living to age 86 and beyond. But at least one member of a couple is going to live until age 90. So this is a pretty staggering fact when you're considering, a generation ago, Canadians who were retiring or typically retiring at 65 and maybe only living until their mid-70s. So, given this information, my question to you as a listener is, how long do you need to plan for your nest egg to last? How long should you plan for it to last? So this is a kind of a fun slide, this next one here, and I sort of touched on inflation a little bit earlier, but if we're comparing the cost of fast food prices today versus the 1960s, these must be McDonald's prices, because I don't know anywhere I can get a hamburger for $1.29. So let's just have some fun here. Feel free to type in your answers into the chat. What do you think, French fries and hamburgers and a hamburger would have cost you back in the 1960s versus what it costs today? So I'll give everyone just a second here to answer. Okay, I think I got a couple close ones here. Okay, so I'm gonna let everyone see this in a second. So 30 cents. So, French fries and a hamburger back in the 1960s was 30 cents. But the point of Howard, you nailed it. So what I want you to notice here is that over that 50-year time period, there's been about a 10-fold increase in price. So this is what inflation is at play, right? So when I'm talking about, the average Canadian retiree today, inflation is going to be a really important factor in their retirement, especially if we're talking about 25, 30, 40 years of retirement. The cost of living is going to increase substantially over that time period. So are you making sure that you built this into your plan, and do you understand what the effects are going to have on your ability to maintain your lifestyle over that long period of time? So it's important to keep this as a factor. Next slide here. So poor early performance can alter your retirement plans. And this is absolutely true. People retired at the beginning of last year and they saw their portfolio drop 10, 15, 20%. And that's a really scary thing, to sort of experience right when you stop working and you don't have this regular paycheck coming in. So it can feel, much like pushing a boulder up a hill. And so you can imagine these people going through these types of life events. So my question again is, how do you manage this type of situation? Do you just tighten up the belt and live on beans and ramen for a bit, or do you have a plan in place for these types of events? And so I mentioned this a little bit earlier in the webinar, but one thing I've noticed with a lot of new people that we've spoken with is they don't have an income strategy in place for this. So one strategy that we utilize with our clients that you can utilize in your portfolio is have what we call a cash wedge. So this is about 3 to 4 years of guaranteed income carved out in your portfolio. So when markets decline, you have a guaranteed cash wedge to draw from and pay for your lifestyle, and you never have to sell anything at a loss. And that gives you, 3 or 4 years of time for the equity side of your portfolio to come back, right? So this is a simple strategy that you can look at putting inside of your retirement portfolio. So it's more important than ever when you're looking at that portfolio to have a plan on how you're going to capitalize on these opportunities or protect against the events along the way. So in a world of averages, this next point that I'm going to get to here, if you're on this call this morning, I'm sure you've used probably a good chance that you've played around with those retirement calculators that you can find on Google. What I want to hit on here is that, these tools can be really useful on their own, but they don't capture the whole picture. And here's an example of that. Let's say that you have a $100,000 nest egg going into retirement. You've determined that you need to draw $600 a month to pay for lifestyle, and you expect that, a 5% average rate of return is realistic for your portfolio. So if you type in these numbers into a calculator, it's going to tell you that, your nest egg should last about age 89. So I think for a lot of people, they'd be okay with that. But the key word here is average. So when you're considering averages in these types of calculators, what this is essentially telling you is that in this case, 50% of the time, your money is going to last until 89 or longer. And 50% of the time, your money's actually going to last until 89 or less than age 89. So if I asked you, how do you feel about those odds? You've got a 50-50 chance of your money lasting long enough through retirement. I'm going to guess a lot of people are going to say not so great. So what we really want to focus on is not averages in retirement, but what's the probability of retirement success? What's the probability of my money lasting long enough? And sort of take this another step further as to why averages can be a bit misleading, I'm going to show you a couple examples here. And why, sort of, not an average rate of return, but sort of the sequence of return is much more important. So if I'm looking at, 3 years, let's say this is the first 3 years of your retirement. Year 1, you get a 5% return. Year 2 is a negative 15% return. And then in year 3, 25%. So if I look at the average of these three, it's still a 5% average. And it's a little bit more realistic than getting 5% each and every single year. But you just got it in a little bit more of a volatile way. So what effect is that going to have on the longevity of your nest egg? You can see right away that you're going to deplete about 6 years earlier. So when we're looking at this graph in comparison to that 5% every single year, just by changing the sequence of your returns, your money's going to run out about 6 years earlier, which is pretty substantial. And if we look at it, in one other way, if we go the other direction, rather than going clockwise, we're going to go counterclockwise, this time. So we get the 5% again in year 1, but in year 2, we get the much better 25% return. And then in year 3, we get the negative 15. So if I add these up and take the average, we're still 5%. You just got it in a different order this time, in a different sequence. So let's see, what is that going to do to the graph this time? So if you thought it would last a bit longer, you're obviously right. So that return sequence actually made your money last about 4 years longer. But what else you're going to notice is that in both of these examples, they're still less than the original age 89 projection. And that's sort of the shortfall when you're looking at averages, that you don't capture the reality of the bigger picture, and that your sequence of returns is actually going to have a really strong effect on the longevity of your money. So now some people might look at this and say, hey, Matt, what's the big deal here? But this is a big deal, right? It's a very, very big deal. In fact, it's such a big deal, you have to appreciate that this is the exact same amount of money, the exact same average rate of return, same withdrawal rate, but that sequence of returns could be the difference between someone, retiring comfortably or them running out of money early and having to dramatically change their retirement plans. So this is a really important thing to look at. So retirement sustainability, also known as, how much can I spend and not run out early? And I had just mentioned how the probability of success in retirement is the metric that we actually care about. So we don't want to focus on averages, we want to focus on the probability of our money lasting. So looking at another hypothetical situation here, let's say that you're entering retirement at 65, you've got $500,000, you're expecting a rate or a withdrawal rate, excuse me, of 5%. So that means that you're going to be taking out $25,000 a year, and you expect to have a rate of return of around 5.9%. So based on the averages, the metric we said that isn't as accurate, this nest egg should last to age 100. But we just got done talking about how that, the law of averages doesn't capture the whole picture. It's just not realistic. You're not going to get that return every year. So rather than relying on those averages, our planning software that we use is going to account for the variability or the sequence of returns by testing thousands of different scenarios. So to show a whole range of possible outcomes. So what you're seeing here is that those same variables that we had on that previous slide, you're seeing all the different potential outcomes that could happen using that same type of stress testing on the previous slides that we were looking at. So some of these outcomes are going to be great, right? Your money might last past 100, which means that you could have a larger estate, but some of them are not going to be so great. And so what this allows us to do is that once we have the probability of or the likelihood of your retirement success, we can actually give you a grade on what your retirement plan looks like. Is it an A? Is it a B plus? Is it a C? So what do you think the probability of retiring comfortably is going to be if you're just looking at averages? Okay, so segueing into that question again about, how much can I take out? This is a really important slide that I would say that you want to pay attention to. So, very common question that we get is, how much can I spend every year and not have to worry about running out of money? Really what that is what's the safe withdrawal rate? So let's say we're using $100,000 as an example again for your nest egg for simple math. And let's say we wanted to draw 4% out every year from the $100,000. That's $4,000 a year, right? So what these columns on the right here are saying, okay, what's the probability of that money lasting for how many years? 20 years, 30 years. You can see after the 30 years, your probability drops to about 95%. But honestly, those numbers are still really great. But let's say we increase that withdrawal rate from 4 to 6%. An extra $2,000 a year. Maybe this person wants to have an extra vacation every year. Over 30 years, you can see that you've lowered the probability of maintaining that retirement lifestyle to about 55%. So at that point, you're sort of rolling the dice by just increasing the amount you're withdrawing on an annual base by 2%. So having a really good understanding of your withdrawal rates is gonna be really important for impacting, how long is the money gonna last for? What's the probability of it lasting throughout my entire retirement? Okay, so I'm going to segue into a bit of a case study here, but I've got a couple questions, so I'm going to see if I can answer one of them here before we move on. Lisa, good question. So at what age can you start income splitting? What income is eligible to income split? So you are eligible to start income splitting things like your RSP or your RIF at age 65. If you have something like a defined benefit pension, let's say a HOOP pension or an OMERS pension, you are allowed to start income splitting that with an eligible spouse as soon as you start collecting it. So let's say you retire at age 60, you start collecting your OMERS pension, you're actually allowed to income split with your spouse at that time. So there's several other income splitting opportunities that I can follow up with you in email afterwards, but we're just going to move on here onto the case study. But if I know there's a lot of questions here, I'm going to see if I can get to them again in a minute. Okay. So in this case study, these are actually real clients of ours. We've obviously changed their personal information to protect their privacy. But when we met Nicole and Sam, Nicole's 59, Sam's 58, they were really adamant about retiring in 2022. That was the year that Sam was going to turn 60. So we're at, less than a year from now. When we met Sam, he's working from home now, but he was previously commuting from Guelph to Mississauga, and he was fed up with that drive. So he was totally ready to retire when we met him, and they really just wanted to get a bit of a second opinion on their situation. They told me that at that time they enjoy their beautiful home in Guelph, and they want to stay there in retirement as long as they're physically able to. They didn't have an extravagant lifestyle, but they like to take a vacation once a year, someplace warm. And they also had a family cottage in Port Algon that they like to spend, a month or two in the summer at. So this is a cottage actually that was on Nicole's family for a couple of generations. So they were just looking for a second opinion. Are we okay? We're entering retirement. We just want to make sure that we have a bulletproof plan here. The Port Algon cottage as well that they pointed out, they also wanted to make sure that this went to their son, who I'll call Al for this case study, in the near future. They wanted to transition that to him sooner than later and kind of just get it off their plate. So they had $1.3 million in various savings that they had put away. They also had some money saved from an inheritance. And if you look at the investments here based on the rate of return, I would say they're probably in the moderate to moderate conservative risk profile. So, things like the GIC at 2%, that might be something that would be a little bit concerning, as well as the tax-free savings account only having a rate of return around 2%. I know that, when we look at TFSAs, a lot of times they've sort of been marketed as additional high interest savings accounts, but they're actually one of the best places to have more aggressive investments and take advantage of that tax-free growth. Okay. So this was their current plan when we met with them. Nicole still is working at a very well-known and large Canadian bank. And prior to meeting with us, they had actually sat down with an advisor there and they put together this plan. Some of the strategies that they had in here that I'll just rhyme off. They were going to start drawing from their RSPs early to spread out the tax bite over time and lower the tax bill on the final estate. They had also decided they wanted to move the cottage over to their son Al sooner than later and just pay the capital gain now. They would also continue paying the property tax payments for the cottage, and that's sort of what they had earmarked their GIC for. Their son Al didn't have any material savings at that time or any extra income. He was also engaged to someone that they didn't really know that well, and to be honest, they also didn't care for her that much, which isn't really an uncommon situation nowadays. And finally, their strategy was that they would use their tax-free savings accounts to cover any shortfalls in income each year and pay for any lump sum expenses like the capital gains tax for transferring the ownership of their cottage to Al, especially when they were in a high tax bracket. So moving on. So that was their current plan. And if we were looking at, okay, well, we've looked at their strategies. Now let's look at their cash flow. So looking at their first full year of retirement, which is year 2023, you'll notice that they have two different types of expenses here. They have fixed expenses, things like, utilities, groceries, property tax, things that you just can't get out of. And then they also had about $40,000 of discretionary expenses, which are things like travel, their gym memberships, going to restaurants, that kind of thing. So in total, they had about $111,000 of expenses every single year that they wanted to maintain throughout retirement. So even though we knew that they needed to spend $111,000, it was actually going to be much higher than that because we have to account for tax, right? So if we're estimating that they're going to need about $160,000 before taxes every single year to maintain this lifestyle. So when we figured that out, we knew that there was going to be a pretty large gap as well. So the next thing to look at is, okay, well, what's their fixed income? So these are the guaranteed income sources. Nicole had a pension through her work, $55,000 a year, and this would be one that you could pension income split. We'd estimated they were going to have about $22,000 a year in Canada pension and old age security when they were eligible to collect those. They had about $6,500 of GIC interest income. And the rest of that gap that we're talking about, so if we total these fixed incomes up, we knew that they'd have guaranteed income of around $83,000. Well, they're going to have to fill that gap from their RSPs, their tax-free savings accounts, and their non-registered account. So when they sat down with their previous advisor, he looked at everything, they modeled it out. They said that they were going to maintain this lifestyle well into their 90s, and that was going to be no problem. So when they were referred to us by an existing client, we were looking at, okay, well, what are some second opinion type options that we could look at that might improve their situation, right? Whether or not their plan was actually going to be realistic or not. So the first thing that we looked at, that's been asked a few times already today, is that, well, what if we looked at, a simple strategy such as pension income splitting? Number two was, well, what if we actually redeemed the RSPs until later? And this is a very common question of, when do I start drawing these RSPs? It's going to be different for everyone's situation. So it's important to quantify this. So we looked at, instead redeeming the RSPs later, deferring that tax bill down the road, and then instead drawing the non-registered and the tax-free savings accounts first. Number three was, well, what if we added another layer of guaranteed income? What if we added in a small annuity? An annuity is essentially a guaranteed payment for life to provide the guaranteed income that they had planned for major expenses early in retirement instead of the GIC. So annuities aren't necessarily something we'd recommend for everyone, but in this particular case, it made sense. Number four was, well, let's review this tax-free savings account and maybe reorientate or retool the portfolio to make it more growth-oriented and align with their risk tolerance or their sleep at night factor. So we also wanted to make sure that they continued saving into their tax-free savings accounts every year. So even though they're not working and they're making those annual deposits, we still want to move money, even if it's from the non-registered accounts to the TFSAs every year. And finally, we want to make sure that we're deferring any redemptions from tax-free savings accounts until later in retirement. We don't want to deplete them early. And then lastly, number five, which was really important to them, was this generational cottage. So we looked at, well, what if we deferred the transfer of the cottage and the payment of those capital gains until well into the future, quantifying why, if possible, we always want to defer those really large lump sum expenses until later retirement. So even with the payment of the capital gains being a primary concern, we also wanted to talk to them about, the risks of gifting the ownership to their son now that would also become a marital asset between him and his wife, which I had already mentioned that they weren't maybe the biggest fan of her. So there's a couple other risks that we had to explain to them as well. So whenever we look at someone's current situation and we look at, okay, well, here's some strategies that might help improve their situation, we're going to quantify them. So the first thing that we did was we modeled their current situation, their current plan. And right away, red is not good when we're looking at these retirement plans. So we found that there was actually going to be a pretty significant shortfall near the later stages of their retirement. And if you added up all these red bars here, it was about $520,000 that they were going to be short in terms of retirement income. So that's a big deal. So after analyzing that current situation, the next thing to do is take those strategies that we recommended and see, does it make it better? So looking at the cumulative change for each of these strategies, I said that their current situation was going to have about $500,000 in shortfalls. That means that they were going to spend about $6 million over their entire lifetime in retirement. They were going to pay $2 million in taxes over this retirement, and they were going to be left with an estate of about $2 million, which would be mostly their principal residence. So based on everything that we had quantified, we had determined that their probability of success, the probability, not the average, was going to be about 66% chance of this actually playing out because of that big shortfall. So, for most people, I don't think, a retirement grade of C is what they want to see. So we looked at, layering in each of those 5 strategies, the first one being something as simple as just pension income splitting. When we modeled that out, right away, we saw that it would improve their situation, reduce their shortfall by about $100,000 with that very simple strategy. The second strategy that made a huge impact was that withdrawal sequence. And I talked about this earlier, was how important it is to understand what your withdrawal sequence is going to be. So what if we change the order of the withdrawals, and we took the RSPs out later and we started drawing from the non-registered first. So it was a pretty dramatic increase in their retirement success. And this is why there's no, sort of one size fits all for these types of situations. It's something that can't be answered without quantifying it. So, and the order that you're seeing here was the right order for Sam and Nicole, but maybe wouldn't be for everyone listening in on this call. The next one was to purchase a small annuity with some of the GIC investments. So again, not something that we always recommend are using annuities, but based on their situation, having a little bit more of a guaranteed income stream was something that they were looking for, and it also improved the probability of success. Number 4 was restructuring and deferring the tax-free savings account withdrawals. So the fourth recommendation was essentially, hey, let's take advantage of all this tax-free growth that we have within the TFSA and retool the portfolio a bit. And then also making sure that we're not drawing from those TFSAs early and running out of some of our more liquid investments first. So because of those two changes, you can see it also moved up their retirement success to about 92%. And then lastly, was the really important factor for them was this cottage that they wanted to give to their son. We reviewed with them, well, what if we really just deferred those capital gains until later? We don't transfer the ownership until later in retirement. What is that going to do to their retirement success? So after applying all of these strategies, they'll have been able to spend an additional $520,000 over their retirement. They would have to pay a little bit more taxes along the way, but that's something that they were more than happy to pay for, given that they were going to have a lot more spending throughout retirement. And they'd also have an additional $1 million in their estate to pass on to the next generation, even after that cottage capital gain was paid. So when considering variable returns and rates on those, the odds of Sam and Nicole enjoying a successful retirement had gone up from that 66% or that C grade to a 95% to essentially an A+ retirement grade. So I remember this meeting with them. I can tell you they left the boardroom feeling a whole lot more confident about their retirement. So it's always really important that you look at analyzing your current situation and then testing whether or not strategies like this are going to improve or not improve the situation, right? It has to be quantified though. So I'm going to answer some questions here again in a minute, but I just wanted to sort of wrap things up with touching a little bit on our approach as a practice. So, at the beginning of the webinar, I introduced myself and Neil, who's the principal, but we're also surrounded by an incredible team here. We're fortunate to have another consultant, Doug Steinberg, who's an advisor in our London, Ontario region. Nicole Germano, who handles all the behind the scenes prep work and support. Margaret Wilcox, who does all the transactions and follow-ups. And last but not least, Lisa Pearson, who books all of our client meetings and sort of the frontline contact manager. So together we bring a really strong synergy to the value we provide to each of the families we have the privilege to serve. So our process, so if we're looking at building a financial plan for you, it starts with exploring your current situation. So getting an understanding of where your point A is or where you are today by collecting a bit of an inventory of your information. Then we're going to look at clarifying your objectives by asking the right questions. So there's 4 really important questions that we're going to go through with you to better understand what's important for you and to put together what we call a bit of a vision statement for your retirement. Then, like you saw with our clients, Nicole and Sam, we'll develop a comprehensive plan that gets you from point A to B. We'll design an investment program for you based on your risk tolerance and whatever your income needs in retirement are. So this could be ETFs or individual stocks or private pool type accounts, whatever works for your situation. Then we're going to look at implementing those strategies because it's not just about the investments, it's about all aspects of your retirement life. And then finally, where the majority of the time and work is spent is on proactively monitoring and adjusting your plan, making you aware of changes that could affect your plan and ensuring you're staying on track the entire way. So a couple more slides here, but this is the moment of truth. And I'm sure a lot of you have been taking notes throughout, but if you haven't, or if you don't have a pen and paper handy in front of you, I'll ask you to grab one now. We're going to go through 16 really short questions from Rob Carrick, who's an author at the Globe and Mail. And I'll ask you to answer honestly about your current relationship with your advisor. So first question here, I hear from my advisor once a year minimum. And when they're calling you, is it just, reviewing your statement and talking about rate of return, or are they actually getting, more in depth on their questions? I get a response to calls and emails within 24 hours. So are they responsive to getting back to you whenever you're reaching out to them? We have talked about guaranteed retirement income options beyond Canada Pension and Old Age Security. So there's a ton of different options out there if you're looking for a little bit more guarantee in terms of income. Have you investigated those and determined whether or not they make sense for you? My advisor asked me questions about life, goals, aspirations. So we have a really close relationship with all of our clients. We understand, what's important to them, what charities they're looking to donate to, what are their goals and aspirations? So are they asking you those types of questions? I have a copy of my written financial plan, and it's updated often. And what I mean by often is at least once a year or anytime there's a major life change. If you are in a relationship, both partners' views are being addressed. So I know there's always, sort of one financially motivated spouse and maybe one spouse that isn't as interested, but it's extremely important that, both partners are being heard. My advisor tries to help me improve my financial habits. Yes or no? My advisor covers matters beyond investments like debt, taxes, insurance, estate planning. I have a clear understanding of what I have in my portfolio and why. It's not just a mutual fund and I have no idea what it's invested in. I have no idea what their mandate is. So having a good understanding of what you actually own and pay for is extremely important. I have maximized all income splitting and tax deferral opportunities. Yes or no? My advisor has clearly explained the cost of ownership of my investments. So whether you're paying fee-based or fee-for-service, or they're trailing commissions, do you understand what you're actually paying? My advisor is a certified financial planning professional. So do they have their designation? Are they constantly trying to continue their education? My advisor understands my tolerance for losing money because we have talked about it. So when you see a statement, have you ever felt shocked by what you're looking at? Is it, or do you have expectations in place for those kinds of things? I have a current will and powers of attorney. So what I mean by current will and powers of attorney is that these are typically documents that you want to review every 5 to 10 years, or if there's been a major life event. We review these, our legal counsel that we have on staff reviews these for our clients, and we can liaise with your lawyer as well. My advisor is a simplifier. I come out of interactions with greater clarity. So, when you leave a meeting with them, you understand your plan, you understand the changes that you made, or are they just, talking about things that are a little complex and not really simplifying that for you? So yes or no to that? I am confident my savings will last throughout retirement, even with market volatility, right? So are you guys talking about averages, or are you talking about the probabilities of your retirement success? So yes or no? Okay, so I'll ask you to tally up how many times you said yes here. And if you ended up with 14 to 16 yeses, you probably have a rock star of a financial advisor, and they're doing a very good job for you. If you have 10 to 13, there's probably room for some improvement. 7 to 9, I would say, you should definitely be getting a second opinion at that point. And if you only have 6 or less, I would say, maybe not right now because of COVID and social distancing. I wouldn't necessarily run to a new advisor, but I would say it's probably time to review things. Okay, so we're about to wrap up here, guys. I'm going to try and answer some questions before I go. But my offer to everyone on this call here is to take you through the process of building a personalized financial plan for yourself, much like you saw pieces of it with Nicole and Sam. And the reason why my team is willing to offer a time like this is because we know that ultimately you're going to end up being the judge of the quality of our work by examining the type of planning work that we do. So this is what our practice specializes in, and it's focusing on retirement income planning. Okay, so I'm going to try and answer a few more questions here, guys, because I know we're running out of time. Again, if I don't get to answer your question today, I'm going to follow up with you afterwards. I got a question here from Mike. Mike asks, what annual inflation factor do you typically use for estimating long-term cost of living expenses? So that's a really good question, Mike. So we typically use 2.5% as our inflation metric. So, every year we're estimating that the cost of your living expenses is going to go up by about 2.5%. This is based on a historical average, as well as the Financial Planning Council of Canada puts out these estimates every year. So 2.5%, I would say, is a conservative number to use. In Canada, over the last 10 years, inflation has only been around 1.8 to 2%. So you're being a little bit more conservative by using that 2.5%. But I would say, over the course of the next 20, 30, 40 years, we probably won't be under 2% the whole time. So that would be a good number to use. I got a question from Howard here. Is it wise to rely on dividends as a source of income and ride out the ups and downs? So Howard, that's a really great question. If you're able to set up a portfolio in such a way where you can live on the dividend income stream, I would say absolutely that's a valuable strategy that you can look at. So, even when the markets are going up and down, you still have the exact same amount of units. So if the units don't have, if the dividend isn't being cut, then that's a good source of income. But what I just mentioned there is that there is that risk that a dividend could get cut at a certain time, right? So if you have $40,000 of dividend income, but then we move into a recession period and some of these businesses cut their dividends and that 40,000 is now 25,000, it's important to have other strategies in place to make sure that you can fill that gap. Okay. Question here from Sean. Sean asks, I plan on retiring in 2 years from now. Should I stop putting money into my RSPs and just put money in my TFSA? So Sean, great question. This is one that I'm going to follow up with you afterwards. I'm going to have to figure out what your current income is now and what your income is going to look like in retirement, because it could make sense that you stop using your RSP now and that we just use the TFSA. But depending on where your taxable income is today, the next 2 years actually might be a good idea to be topping up your RSPs while you still can. Okay, so I think I'm going to have Lisa, if you can drop my calendar link in here one more time, because we only have about a minute or two here, guys, before I have to let you go. If I didn't get to answer your question, I'm going to follow up with you. If you want to book some time with me, if it's 10 or 15 minutes, please click the link that Lisa just dropped into the chat there, and I'll be happy to spend some time with you. So I just want to thank everyone for spending their morning with me today on a Saturday. We're going to be sending out an email for some feedback afterwards. If you could, please take the time to fill that out. I always find we get the best feedback while things are fresh. So I'm going to be following up with everyone this afternoon. Again, if you want to book a meeting, just please click the link and pick a time that works best for you. So I hope you learned something here today. My name is Matt Lippert, and I'm saying, have a great weekend, everyone, and thank you for your time.